come from, and where will we be going over the next couple of years? Likely, obviously, if I knew exactly, I'd be off making millions. But this is, to me, this is the demand side. The dark line that goes up there and is now down there, that's the change in house prices year on year. And you can see that things were at their craziest in the late 1990s, but we're still pretty crazy, still 10% year on year for most of the noughties as well. And the two things, well, there's three things, one I couldn't graph, there's two things that are on the graph that I think are primarily responsible for the upward pressure on house prices. The first was the change in unemployment, which is the red line. Now it's inverted so that when that line goes this way, that's actually good. There's more people being employed. This is the change in unemployment rate. There's unemployment falling, there's unemployment rising, there's unemployment falling again, and then unemployment, as you can see, 2009, I cut it off at 40% because unemployment, the change in the unemployment rate this year is actually going to be 80%. So it kind of made the rest of the graph tiny, so I had to cut it out. But even if it levels off there in 2010, 2011, that's one suggestion that if unemployment levels off, even if it levels off at a high level in 2011 or 2012, that's one stop to the downward pressure on prices. The other one is the real property interest rate. So we all know interest rates. Interest rates are incredibly low at the moment. Surely that should be stimulating borrowing. Well, obviously, you have to factor in the change in prices as well to get the real interest rate. We can go one better than just do CPI, a real interest rate. We can actually look at the real interest rate for the property sector, which is the change in house prices subtracted or added to. I always forget. It's one or the other, so that makes sense. The interest rate. So if you have a situation where house prices are falling 20% year on year, all of a sudden the real interest rate becomes, for property, becomes 23% rather than just 3%. And when you put it like that, it's very obvious why people aren't buying at the moment. They're taking a look at how much prices are falling, and they're saying, well, there's no way in hell I'm going to try and catch a falling knife. I'm just not interested. So employment was the macro factor, and falling unemployment is the macro factor in terms of the number of bums on seats or people who actually are interested in buying properties. And how they turn their latent demand into real demand, how they turn it into a price, is going to be determined by the interest rate as well. And you can see with a pause in the early 1990s, the overall picture up until 2000 was the pressure was getting more and more heated. Now what happened, it's the third point here, the tax breaks. What happened in the noughties was tax break led. Probably people know this very well, the Section 23 disease, it's what's known as now, every marginal constituency in Ireland had its own little property boom because it was deemed to be a market or an area in need of regeneration, rural regeneration, urban regeneration, whatever it was. Every place in the country had its own little boom. And that's, that's what you see there. The final couple of years of the boom were really avoidable if the government had been counter-cyclical and hadn't introduced, that's two separate things. One, counter-cyclical, and two, hadn't introduced or kept on the tax breaks that were in place. And the result is that you had a building boom in places in Leitrim and Longford. And of course, the builders who go there and say, well, I'm not going to buy here, I'm going to rent here. All of a sudden, rents shoot up in Leitrim and Longford. So people go, we need even more properties because rents are on the way up, just like they are in Dublin. Rents are now on the way up in Longford. Builders finish their buildings, off they go, no one renting property, no one buying property. And that's we'll get onto that in a minute, the supply side. But that's a big worry for some of the regional markets around the country. This is the supply side. my estimate, and obviously people can argue around the margins, I think fundamentally it's in the right ballpark, is that we needed about 10,000 new units every quarter, based on long-term demographics and so on. Now you could argue that in 2005 we might have needed maybe 15,000 for a couple of quarters to adjust to the new influx of workers from different parts of the EU. But overall, we're looking at about 10,000 units every quarter. What we actually got every single quarter from 2002 to 2008, we got significantly more. We got more, and in some quarters significantly more than the 10,000 we needed. And what that means is, you can see in some quarters it was 25,000. What that means is the red line measures the cumulative oversupply, if you accept that 10,000 a quarter figure. The cumulative oversupply of property that Ireland built up over the boom years. And one little snippet I like to give is that Connacht and Ulster, more properties were built between 2002 and 2007 in Connacht and Ulster than were built in Dublin. And they have half the population of Dublin. So it's not just that we were building a ridiculously high number of properties. It's also that we were building them in the wrong places. This is section 23 disease. So Davies have estimates of what this is going to be, what these bars are going to be for the next few years, and it looks like it'll actually go as low as maybe 1,000 or 2,000 for a few quarters. Now, you'll need to do that for quite a while in some parts of the country to get this figure all the way back down to zero, the oversupply. Again, doing some quick calculations based on the amount of new homes built over the course of 2002 to 2007. Do that for different regions in the country. So the overall lesson, or the overall punchline, is that we built 12 years property in 7 years. So we have that 5 years extra sitting around. But in Connacht and in Ulster, they've managed to build 15 years in 7 years. So not only did they double us, they had a little bit extra as well. So you're going to need an awful lot of, Morgan Kelly talks about destroying properties to correct for this 200,000 excess supply. I'm not sure it necessarily comes to that. The phrase I would use is intergenerational outsourcing. That we got one generation to build all the homes we'll need for the next 2 generations. And now these people are free to do something else. For the love of God, let's try to find something else to do. So there is an element of that in terms of unemployment policy as well. There's no sense at all that these people are going to be needed to build houses anytime soon. So we do need, if they're young enough, we do need to retrain them for whatever there is a demand for, and that's obviously an entire thesis in itself. That's just a quick look at different measures of house prices. Just a quick recap. So supply, demand, and prices. This is the price side, and there's a map there of which are the worst affected areas. You can see Munster, blissfully unaware of well, not blissfully unaware. They have fallen by 15-16%, but certainly not as much as the deeper blue colours around Dublin in particular. Where it starts to get serious, and this is where, as I say, I go a little bit off the script in terms of the DAF message. So this is me speaking as an economist rather than as a DAF spokesperson. But we're doing some research at the moment with UCD in terms of looking at negative equity, and what are the implications of negative equity, what's the size, the incidence, and what could it be if house prices were to fall under 25%. So this shows the percentage of all households in negative equity currently. If you take as a rule of thumb that asking prices are 10% above prices actually being achieved at the moment, and if prices were to fall a further 25%, that's what it would look like. So the scale there is, that's Leitrim, almost a quarter of all households would be in negative equity in a year's time if house prices fell by 25% in that period. That's the worst case. Laois is not so great either. There's some counties like Limerick and Tipperary which would be less affected. They saw much smaller levels of construction and much smaller levels of price increase over the boom years. But you look at it, again, the punchlines: 250,000 households would be in negative equity approximately